Those of you who are veterans of the CEPR Summit will know that it's really hard to find two economists who will agree on almost any substantive question of economic policy. But I want to assure you that the set of issues that Bill has just laid out for us, the long-term challenges to fiscal sustainability in the U.S., the need to do something, whether it's on the spending side or the tax side or on the economic growth side, to try to bring into closer balance the commitments that we've taken on, particularly at the federal level in the United States, and the long-term projections of the revenue that we expect to raise are broadly agreed upon. Right? There's little debate about the fiscal challenge that lies ahead. There's great debate about precisely what the best way to tackle this challenge would be. And what I'd like to do with you this morning is to kind of lay out some of the terrain on some of the tax policy options and to give you a framework for thinking about these issues. On the eve of the French Revolution, when debt service interest payments were about 60% of the outlays of the French government, Colbert was the finance minister. And Colbert said that the art of taxation was the plucking of the goose with the minimum of squawking. And that, in some sense, it's a crude way of describing the theory of optimal taxation that economists have developed since. But in essence, what we want to think about this morning is how does one try to find the least burdensome and the least painful set of tax options going forward. And let me emphasize at the outset that I'm not going to say very much about the spending side because there's further discussion this afternoon about health issues. Entitlement reform on the Social Security, the Medicare, and the Medicaid programs almost certainly will play some important role going forward in bringing the lines that Bill shows you diverging back into closer contact. Exactly when and exactly how is a harder challenge to predict, but I don't want to belittle by my omission the fact that entitlement reform is likely to be a key element of what happens. The other thing I don't want to omit is the point that John Lipsky raised this morning about the critical role of economic growth in helping us to deal with the challenges that loom, right? In the sense that all of these burdens, paying for the commitments that we have locked in, are going to be much easier in a robust and rapidly growing economy than in an economy which is locked in a decade or longer of sluggish economic growth. Okay? And that imperative, thinking through the growth consequences of whatever policy changes we make, is, I think, very, very important to keep in front and center as we try to consider what the various ways that we might tackle these challenges could be. Okay. So let me start by just sort of explaining that if one thinks about the ways one can act on the tax policy side, basically there are, you can just describe two paths. There's a fork here. One is one could try to raise more revenue with the existing tax system, and the other is one could consider moving toward new revenue sources. And the higher rates option or broadening the base are basically the two ways one can get more revenue out of the existing income and payroll tax system. The new revenue sources that I'll mention include the value-added tax, energy taxes, and securities transactions taxes, all of which have already been mentioned during the course of our discussion today. With regard to the existing tax code and taking on the fundamental tax reform issues and the revenue-raising challenge, I would underscore that fundamental tax reform, trying to make the tax system work better, is a lot easier to do when there's extra revenue on the table than when you're trying to raise revenue. Right? It may be more important to do it when you need to raise revenue because you're about to ramp up the burdens in the economy. But many of the historically successful tax reforms have in fact been in situations where the total tax take was being reduced, and that gives you a little bit of extra change to be able to compensate some of the folks who are going to be losing out as a result of the tax policies that you're putting on the table. Okay? Colbert's squawking is almost certain to take place as we try to move forward within the context of the existing tax code and try to increase the total amount of revenue that we collect. Okay? So let me start, as we look at the existing tax code, one of the things that, of course, you've heard a great deal about lately is the prospect of raising taxes on the high-income part of the population as one of the ways that we might do some deficit reduction. And I think it's important just to get some numbers into the discussion in terms of how much revenue can be raised and what the distribution of income looks like. So I've put up a slide here that shows you the concentration of income, both income, AGI, and income tax liability from 2007, which is the most recent year from which we have IRS data. And I should say that 2007 is probably not particularly informative about what we would see if we had the data for 2009 or 2010, given the transformation in the financial services sector and the very important role of that sector in the top end of the income distribution in the mid part of the last decade. What you see, and to put this into perspective, okay, there are about 143 million tax returns filed in the US at the moment. Okay? The top 1%, that means about 1.4 million taxpayers. The AGI threshold you need to get into that group is at around $410,000 in 2007. That group of taxpayers report between a fifth and a quarter of the total AGI in the US economy. And they pay about 40% of the income tax liabilities. Okay? So we've already got a distribution which involves higher tax burdens by a substantial margin at the top. If you look at the bottom part of this slide, the top 50% of the taxpayers, okay, that's around 71 million taxpayers, account for about 97% of the income tax liability. So the income tax structure has become a system in which about half of the population pays virtually nothing under the income tax, or is in fact receiving benefits through earned income transfer, earned income credits and other things like that. So we start out with that perspective, and then the question is, what's the opportunity of doing more tilting and trying to raise more revenue at the top? So I focused in particular on the question, if one thought about the current 33 and 35% brackets, those of you who are in the midst of doing your income taxes, in 2009, the 35% bracket kicks in at about $372,000, the 33% at about $171,000 for individuals and about $209,000 for joint filers. What would happen if you just played with those tax rates and tried to raise additional revenue from them? Okay? Well, there's about $500 billion of income in the 35% bracket. Okay? So if you raise the tax rate by 1% on just the 35% income, you collect about $5 billion. Okay? GDP today is about $14 trillion. If you want to raise about 1% of GDP, that's about $140 billion. That's a 28% increase in the 35% rate if you're going to get that kind of money. And that assumes that people don't change their behavior at all and that the income just stays there and just waits to be taxed. Okay? And one of the things we know about taxpayers is that they tend to respond to taxes. I don't know if anyone's ever been to, probably many of you have been to Amsterdam. If you ride along the canals, there are houses that are a window and a door wide and 6 stories high. That's because Amsterdam at one point taxed the width of your house along the canal. So you made the house as narrow as possible and as tall as possible. We know that there are other examples in which behavioral response to the tax code is very clear. Okay? And a crude estimate, based on work that Emmanuel Saez, I admit at Berkeley, hard to say in this group, but and my colleague John Gruber have done, suggests that when you change the keep ratio, the amount of revenue, the amount of income you have after paying your taxes, by about 1%, so you go from, you get to keep 50 cents to you go to keep 52 cents, as you go up by 1%, you go up by 0.5% from 50 to 50.5. People tend to reduce the amount of income they report when their keep ratio falls, with an elasticity which is quite noticeable for the amount of revenue yield, particularly at the top end of the distribution, where taxpayers have more opportunities to defer income, to change the character of their income, to decide when they realize capital gains and things like that. So it's unlikely that one can simply expect that the static revenue yield would play out. But even if it did, you get up to tax rates on the 35, or if you move the 33 in as well, you get a little bit more revenue. You get up to rates that are well above 50% and probably above 60%. My guess is that that is something that we are simply not prepared to return to. So that raising rates that high as a mechanism of primary deficit reduction is unlikely to be a part of our future. That's not to say rates aren't going to go up. They almost surely will. But I'm not here to do political forecasts. I'm here to think about what are the economic analysis going to be. The other really important economic input on the policy design question is to try to think about the link between these tax rates and economic growth or economic efficiency. Okay? And one of the key lessons of tax economics is that the burden that a tax imposes on the economy rises faster than the tax rate. It turns out it rises at about the square of the tax rate.